Welcome to Something More with Chris Boyd. Chris Boyd is a certified financial planner practitioner and senior vice president financial advisor at Wealth Enhancement Group, one of the nation's largest registered investment advisors. We call it Something More because we'd like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients on Cape Cod and across the country. Here's your host, J. Christopher Boyd.
Welcome, everybody, to another episode of Something More with Chris Boyd. I'm Chris Boyd. I'm here with members of our team from the AMR team at Wealth Enhancement Group. Russ Ball is in the studio with me. Jeff Perry is in Florida. And Brian Regan is in Boston. So thank you all for being here. Our topic today is to discuss the dogs of the Dow. I've run across this a couple of times recently, and after not having had exposure to the dogs of the Dow for, I don't know, it's been a long time since this came across my radar. But recently, I've had a client who had this position as part of their portfolio, and I've come across an article and a couple other things where people are talking about the dogs of the Dow. So now, typically, maybe Brian, you want to explain for our listeners what the dogs of the Dow is before we? I want to dive into some of the impact of a defined portfolio, but in a unit investment trust. But tell us a little bit about what is the dogs of the Dow.
Sure. Thanks for having me today, guys. It's been a while. It's always fun to do this. So the dogs of the Dow is you take the 10 highest yielding stocks in the Dow Jones Industrial Average, which has 30 stocks in it, and that you make that your portfolio for the year. That's essentially what it is. The idea is if it has a high yield, if it's in a blue chip index like the Dow Jones, then that it might be a good indication of value. So that's the idea.
Yeah. So presumably these are quality companies generally by virtue of being in the Dow Jones Industrial Average. And then you're taking the 10 best income. So people who might be looking for a good yield, we're going to talk about that. Let me come back to this, some of the virtues and merits or not of this as an investment strategy. Let's talk about how this is often acquired. Oftentimes the way people obtain this, it's sold to them by a financial advisor who is selling a unit investment trust. A unit investment trust is a bundle, a portfolio that you can buy. Now, it's an investment product. Oftentimes it's sold by commission, though not always, but generally. And essentially, it doesn't have to be as limited as 10 stocks. It can be something else, some other theme that drives the selection. But it is a portfolio that is retained for a specific period of time. As you mentioned, the dogs of the Dow, the theory is often for 12 months. A unit investment trust often will last for about 15 months, sometimes even longer, more like around 3 years. So depending on the product you might select. I generally think there are other products in today's world that I would utilize as the way to invest. By and large, a defined portfolio is something I'm going to buy in January, but there's no change. Excuse me. There's no change in the portfolio in any way over the course of the year. So there's no window, there's no opportunity for assessment or revision. It's either you own the bundle or you don't. That's essentially what a defined portfolio is. Now, you could argue, well, isn't that true with an ETF or a mutual fund? And in some instances that may be true, but oftentimes there is active management, and we can come back and talk about that, the benefits and drawbacks of that. But in any case, a defined portfolio, a unit investment trust is usually how people acquire the dogs of the Dow. You could certainly do it yourself with the purchase. The question then becomes, are they held in equal weight? Are they held in cap weight? What's the weighting mechanism you use? Is it somehow arranged by yield? So these are things you might not know. And that's why people would typically acquire it in the form of a packaged product. I generally am not a fan of unit investment trusts or defined portfolios. Anybody else want to weigh in on that question right out of the gate? Jeff, Brian, what do you think?
Well, I don't really understand the point of a defined portfolio period ever, because things change. I mean, if we just look at the dogs of the Dow in 2024, for example, Walgreens Boots Alliance was in the Dow Jones at the beginning of the year, and it fell out during the year. So, just from that mechanism, you're not even holding true to your investment strategy is not great as investment strategy. I think this is. We're not even holding true to it, just because we're in a defined position from the very beginning. I believe that we should research our stocks, but also before we buy them, but also monitor them for changes in business model, changes in price, et cetera, et cetera. There's lots of things that could change the value proposition of an individual stock.
Well said. I'm in complete agreement. Jeff, did you want to add to that in any way?
No, I'm not a proponent of it. It's the history of the dogs of the Dow, and that's when you would buy those 10 stocks on the first trading day of the year with the highest yield and keep them, right? You don't take them out if they fall out of the highest 10 dividends. You keep them. So the old
That's right. The in this issue though, if you're having the dogs of the Dow and the position falls out of the Dow, what do you do? Is it now you replace that position, or
yeah? I mean, I guess you keep it, right? I mean, the idea is that you keep it the time in the market, and that's somehow reflecting. I mean, it could go out of the top 10 dividend payers and stay in the Dow because it has a price appreciation, right, or a dividend decrease.
Yeah.
I mean, if I'm gonna try to find a benefit of it, I like things that are have low turnover. I don't. I abhor selling stocks, because when you sell a stock, it's it can mean one of a few things. It could mean that the company has gone south. The business model is no longer intact. The reason why you bought it is no longer there. Or maybe the price appreciated a whole lot, and you're selling a company that you really like just because it's gotten too expensive. There's usually not a lot of great reasons to be selling a stock. You usually want to be holding it for a really, really long time and get those compounded returns. So from that aspect of it, it might hold people to a strategy who might otherwise have trouble with that. I like that idea.
Right.
I don't necessarily love the execution through the strategy of the dogs of the Dow.
I would argue that the place for defined portfolios, unit investment trusts, is largely a byproduct of a gone by era. This is a product that's designed to be maybe a stockbroker sold. It's a product sale where a commission is earned. I just think of that as something that, today we want to design a portfolio. We want to have some ongoing control of that. And we're not just pushing a product that this would, I think, is more of that experience, that era of experience.
Chris, for our listeners, can I take a second and just tell the listeners who they are right now, or who they are for 25?
Sure, good idea.
Might be helpful. So the 10 stocks with the highest dividend rate in the Dow are Verizon, Chevron, Amgen, Johnson & Johnson, Merck, Coca-Cola, IBM, Cisco, McDonald's, and Procter & Gamble.
So, I mean, a lot of names people know. Let's talk about just the concept of one of the things that the dogs of the Dow implies is the investment approach of investing for dividend.
Mm-hmm.
And is that meritorious or not?
It's very common.
It's very common, and there's some attractive features for people particularly who are in retirement, maybe own names, stocks, or a fund that they could just retain and draw cash flow from. And that sounds appealing.
Right.
But that's not really always the way we encourage investors to think. I'm going to let Brian tackle this, the idea of income investing versus total return investing. It's not the first time we've talked about it, but I think it's worth revisiting as a topic.
Yeah, before I go on my normal speech here that you guys are all familiar with, Chris, I thought you said something interesting that relates to this. You said commission products are, time of a bygone era, but so is dividend investing. There was a time,
Yeah, that's a good
probably prior to 1950, where the dividend on an index like the Dow Jones would almost always be higher than,
the
a
appreciation.
treasury rate, for example.
Oh, that's interesting. Yeah.
And the reason for that is because stocks are more risky than fixed, the treasury bond
Yeah,
yields.
that makes
So
sense.
they should require a higher rate of return. And in those days, a lot of the industry was based on returning cash to shareholders through dividends.
Mhm.
Today, we do a lot of that through share buyback, and there's a lot more emphasis on research and development and capital expenditures than there might have been prior to that time. So now the emphasis is
And
on
and the type of businesses that comprise the economy, there's been some evolution of that as well, and that may be part
Right.
of why, right?
I mean, to say the least, right? Before 1995, we were a bricks and mortar economy, and now we're a much more of a bytes and bits economy, and that has reshaped a lot of the ways that we should be thinking about investing. If you look at margins on the S&P 500, for example, from that time, we went from 6% in 1995 to almost 13% today. That is indicative of software eating the world. Margins on software are much greater than you'll get from selling items through Walmart at a discount. So that's just one example of how the economy's changed and how we need to think about that. But in addition to that, the reason why we don't, we buybacks were far less common than they are now. Buybacks are a way of returning capital to shareholders that's more tax efficient than dividends, and it often gets overlooked, especially when people are concentrating on dividend yield. It doesn't say anything about the buyback yield here. Part of that is good reason. The buyback is often temporary, where the dividend is often more consistent, but not all the time, and that's important, especially when you're looking at some of these very, very high dividend paying stocks. Sometimes they have very, very high dividend yields because the dividend's going to be cut. So that kind of leads me into the four things that you can do, a company can do with its earnings, right? It can pay down debt, it can buy back shares, it can reinvest in the business, or it can pay a dividend. And for each different type of business, different part of the maturity cycle, different options might be appropriate, right? If it's a new growing company, it might be better for them to reinvest in the business and get a high return on capital. If it's a more mature business, like say Coca-Cola, which is here in the Dogs of the Dow, it might make sense to pay a larger dividend. But that's company specific, and it doesn't necessarily mean that one is better than the other. If you have a really highly indebted company that is trading at a very, very low valuation because of its prospects of possible bankruptcy or lack of funding, and then it gets a lot of funding, even if it's through the equity market, you might see that stock go up because the reason why the valuation was depressed was because of the heavy debt load. So a lot of how we evaluate stocks, it's too simple to look at the dividend yield and say it's a good value. You need to look at the cash flows, the growth, and what they're doing with those cash flows, and whether that business model is going to continue well into the future or if it's a flash in the pan.
So I think we have said over and over again to our listeners that as much as sometimes it can be attractive to think in terms of buying on the basis of dividends, very often we might be taking on risk we don't recognize. The quality of the company that has a very high dividend may be at risk, right? There may be added risk there. There may be some concern of the future earning capabilities. Brian, you've talked about in many instances with clients examples of a high paying dividend company, but it's funding their dividend through dilution of share value. There can be other considerations that can be problematic, right? So we often see instances where yield is, as much as it can appear to be attractive to the investor, may actually be a warning sign sometimes. It may not be as appealing as it might seem. And that can be true with bonds as well as stocks. There can be more risk when it comes to higher yield. Comments?
Yeah, I mean, as you guys know, sometimes I struggle with being diplomatic with my speech, and I've often called those
I never
types of
noticed
stocks.
that.
I've often called those types of stocks that Chris has mentioned as Ponzi schemes, which may or may not be fair. But you'll see that they'll issue shares and then increase their dividend at the same time, which you're basically robbing Peter to pay Paul, which doesn't make a whole lot of sense to me. It's not very common, but it certainly happens. And if anybody wants to contest me on that, I have a couple stocks in mind that I don't necessarily,
Name right now, yeah.
But even
Yeah.
less nefariously, right? Like Verizon is the highest yielding stock on this list at
Right.
6.82%, right? We all are well aware of Verizon. We're well aware of the brand. I'm sure most of us, if not all of us, pay a bill to Verizon. So it's very commonly thought of as a relatively low risk staple, which I think it is. If you look at the financial statements, there's no growth whatsoever. There's not a whole lot of decline either. There's marginal decline, then there's marginal risk. But on the whole, I would say it's the revenue growth is flat. So if the revenue growth is flat and we get a yield of 6.82%, what's your reasonable guess on what your return is going to be on this stock, all things equal? My guess would be 6.82%, right? The company's not growing, and you're getting 6.82% in the dividend yield. You're only going to get the income. You're not going to get much price appreciation. Now, yields could fall, and that could lead to price appreciation. They could restructure their debt, which they have a whole lot of, which is part of the reason why it's depressed stock. They are buying a competitor that could go well, but it probably won't. And I'm not saying that as disparagingly to Verizon. Statistically, most of these large acquisitions do not work. So we have a highly indebted company that's getting more into debt to buy a competitor that's already not growing very much. You're taking a good amount of risk to get that 6.82%. Now, take the S&P 500 for example, that's averaged 14 to 15% over the last decade. That doesn't match up very nicely. And if you think that's an unfair comparison because you might recognize that the S&P 500 might have things in it that aren't necessarily staples, then you can look at the high yield bond market, which you could probably get close to a 7% yield in today, maybe 6.5, something like that on average. So I can actually go down in the capital structure, take less risk, diversify my bond portfolio, and get a similar yield. That is a better prospect to me, and that's why I don't think Verizon, despite its high yield, shows significant amounts of quote unquote value, which I think a lot of people would bucket this as a quote unquote value stock.
Brian, are there any other names in the Dogs of the Dow list that you would want to talk about, that you'd look at and say, oh, well, there's
Maybe
things
not.
coming out there? Yeah.
Well, I love consistency and growth, as you guys know, right? So if you look down this list, and I'll repeat it for everybody: Verizon, Chevron, Amgen, Johnson & Johnson, Merck, Coca-Cola, IBM, Cisco, McDonald's, and Procter & Gamble. That's the 2025 list. Do any of those scream to you that they're going to have any growth in the future? To me, they don't.
Yeah.
I mean, not a single one. Merck's biggest drug is Keytruda. It's one of the best-selling drugs of all time. It's a cancer therapy. But my understanding is part of the reason why Merck is trading down is that the patent is coming up relatively soon, which means that you will get. And I also think it's part of on the Medicare list of negotiated prices. So for those two reasons, the optimism around that drug might not be where you might imagine it to be for one of the best-selling drugs of all time. Chevron is an oil and gas major. It's very, very highly cyclical. It might grow for a little bit, but we know that cyclical is not consistent. So it's not going to get a nice valuation for that reason.
Yeah.
McDonald's it's interesting. There's been times when I've thought about pulling the trigger there. It's certainly consistent. They've had some interesting history with their CEOs. Too much turnover for my taste, which is part of the reason why we stayed away. Procter and Gamble, again, very consistent, but you're probably only looking at 3-4% growth. Trades at over 30 times earnings the last time I checked.
What
Not
about
the
IBM?
greatest
IBM's
trade-off.
been through some revisions, and they've had some iterations. Anything interesting happening there?
I mean, it's been a while since I did a deep dive on IBM, but to me, they should be able to come up with something. That could be interesting, because if you think about, we're in the age of artificial intelligence here, right? And who came up with Watson? Does anybody remember watching Watson on Jeopardy?
Yeah.
I was always amazed at how that kind of disappeared into nothingness, and never really found any.
Pretty common in the business cycle, development cycle, right? The first to have the idea isn't usually the one who makes all the money.
Right. It's like that Gartner hype cycle thing. Have you ever seen that chart? It's a pretty interesting, interesting chart. I like to lay it over the dot-com boom. I think that's, fascinating.
I don't get much activity on my MySpace account anymore. I don't know.
That's true.
Right? I mean, there's a lot of things like that.
Good point.
Yeah. And now, Cisco, one of the interesting things about this, and I was actually talking about this over this past weekend with somebody, I was basically asked, like, can a stock go down because it's priced too high? And I go, do you know that Cisco's never made its 2000 high again in the last 25 years, despite it, continuing to grow and be a viable organization? So there's nothing here that I'm excited about. There's nothing here that I own anymore, for disclosure. So, take that for what it is. But, the dogs of the Dow in 2024, if I'm looking at this article from investing.com, only did 2.53% in 2024. I don't know. That's not too impressive in a year with the S&P 500 to 25%. So, that's kind of my take on these stocks. They're kind of old. They're mature. They might they're cyclical. They might surprise you, but I wouldn't. They don't check my boxes of consistency and growth.
I don't disagree with anything Brian's saying, but I do have a question for Chris and Brian here. So I think one of the reasons that the dogs of the Dow, maybe less than used to be, but is attractive to people is because they want to own a significant number of investors, savers, want to own individual stocks. They'd like owning individual stocks. And how can they do that? Are they just going to randomly pick companies that they know and do a little research and buy them individually? This is a strategy that at least has a theory behind it. It's in companies that are, known, and there's information available about it. I think that's the attractiveness to some people, to maybe employ a dogs of the Dow strategy, and because they want to own individual stocks and they really don't know how to approach it. If you have a client
framework,
if you have a client that comes in and says, maybe they have a portfolio that they're bringing in and it's individual stocks and they want to own them, what's the best advice for people who, maybe have the assets that they can afford the risk of owning some individual stocks? How should they approach that?
Do you want to take that, Chris? Or you want me to run with it?
Yeah, go for it. I'm going to let you.
Oh, well, we have a portfolio of stocks. It's between 30 and 40 stocks. It rarely ever gets as high as 40 stocks because we like to keep it concentrated. Why do we like to keep it concentrated? There's not a ton of stocks that we love, and we want to have good allocations to the stocks that we really like. So, I think my first thought on it is, find somebody that you trust to invest logically in a more concentrated portfolio. Because if you're not going to do a more concentrated portfolio, you might as well widely diversify through an ETF. Right. That's my position. You're probably not going to perform. One of the things about the dogs in the Dow is it's concentrated, right? It's only 10 stocks. I mean, right. It's not the 10 stocks that I would pick, but I would say it checks those boxes. The second thing that you need to do when you're looking at individual stocks is make sure you're diversified. I could argue that the dogs of the Dow isn't extremely widely diversified. It's diversified enough. There's drug stocks, there's some tech stocks, but they're kind of old tech stocks. Right. There's a material stock. It's fine. There's kind of enough enough. This consumer staples, there's kind of enough diversification. What the dogs of the Dow is missing is growth, right? We want to find, if I'm going to pick on one thing that I really think, we want to find business models that are going to continue to grow well into the future, and that's hard to find. It's really easy to find companies that have grown recently. They get a lot of play on CNBC. Usually their stock prices are doing really, really well, and they can be very tempting to buy. It's really hard to find stocks that are going to grow consistently for a long time. And sometimes, and this is a good thing, sometimes they're in very boring sectors. Sometimes they're in exciting sectors. And the good thing about this is that's a great way that we can get diversification. I will take a boring sector that's getting some good growth. I'll give you an example. I know consumer staples that are growing at 8% a year. They're expensive, but that's not bad growth for a consumer staple, right? It's not 100% growth. It's not 50% growth, but it's fairly good. Their banks are reporting this week. They had blowout earnings. They don't always have blowout earnings, but some of the best banks do. Typically do very well. And what do I look for there to get consistency? I look for a diversified bank with a good manager. So what do I mean by diversified? Usually they have custody, they have investment management, they have investment banking, and they have, investment banking can have sales and trading, it can have, advisory businesses, investment management, and then it has conventional banking as well. So those are the four things I'm looking for. Not every bank has that. For example, Goldman Sachs is very heavily indexed towards investment banking, so they can be more cyclical. JP Morgan has, all four categories that I'm looking for. But they're also growing. I mean, their growth, their earnings increased 50% year over year. They've had the same CEO for quite a long time. That's consistency with growth. You might find it in a place like the utility sector, which typically has had 1 to 2% growth, but now is expected to have 7 to 8% annualized growth for the foreseeable future. 7 to 8% growth. Again, it's not mind-boggling growth, but it's 4% higher than GDP. It's 3% higher than nominal GDP. So it's not bad. And if you can get those at a decent price, plus a decent dividend yield, you could reasonably expect 10% on a company like that. Then there can be like staples, like a Costco, or which again unexciting, but they can raise prices on their membership fees, which is cash flow to the bottom line. And they have over a 90% retention rate. So there's things like that are consistent, that have steady growth, that are in a wide variety of sectors, that have proven business models, that you can have a fair amount of confidence that is going to be consistent for the foreseeable future.
One of the things I wanted to include in this conversation is something that I know it's not the way Brian thinks about investing, but it used to be that when we talk about investing, we talk about style boxes and growth and value, and this notion of historically, you'd have this battle between growth and value, and alternate between the two. And we've had this long run where growth companies generally have done better. But the dogs of the Dow represents more of that value end of the spectrum. But I sometimes, I know the way people think about value today is different. It's not necessarily the way we used to talk about it in the past when you think about utilities and you think about dividend payers and things like that. And the way we talk about growth is not necessarily the same. I think perhaps it's more granular. It's more nuanced. It's not necessarily industry oriented, as much as it is company specific. But Brian, I'll give you a chance to talk about that. But I do think that investors still sometimes think about the notion of will there be a cyclical element of the way the economy moves, and whether industries will be benefited by different industry impact in the economic cycle, and growth and value kind of feeds into that mindset somewhat. Do you want to talk at all about that notion of how investors might maybe either correctly or incorrectly think about growth and value and how it should be represented in their portfolio?
Yeah, I think it's a big mistake to spend a lot of time thinking about the style boxes, and especially when you're buying individual stocks, maybe not necessarily on an ETF mutual fund allocation. It might help you get diversified in a way, if you're doing it from that perspective. But if you're looking for individual stocks, as far as I can tell, and you correct me if I'm wrong, but the biggest methodology used to determine whether a stock is growth or value is the price to earnings ratio.
So, yeah.
Would you agree with that?
I think that's true.
I think that's true for the most part. And I don't like the price to earnings ratio. So here's why I don't like the price to earnings ratio. It only takes into account 1 year of earnings, and it only takes into account the current price. So if you have a trailing PE ratio, it says, what's the price today versus the earnings that they made in the prior 12 months.
Mhm.
If you're looking at the forward earnings ratio, you're saying what's the price today versus the earnings that are expected over the next 12 months. So there's some obvious problems with this, right? A company might have had a great 2024, and they would have a very relatively low PE ratio because they had a great 2024. I mean, the market might be saying, hey, it was a one-time thing, right? It was a commodity cycle, for example. You see this sometimes with like steel companies. One time I remember I saw U.S. Steel had a PE ratio of 1. Why did they have a PE ratio of 1? Because it was expected to lose money for the foreseeable future. That's not value to me. That's a dying organization, and that would be bucketed as value. And to me, value is what you get, and price is what you pay. That'll adage, and growth needs to be considered in that formula. So, one of the recent changes that we made in our discretionary portfolios is we sold Verizon, which is in the dogs of the Dow, and we bought Uber. And if we're going to look at expected return, we already talked about how Verizon is expected, let's call it 7%. Let's just round up. They're expected to have 7% growth. Uber is growing, historically, the last couple quarters between the 15 and 20% range on revenue. And they're just became profitable, and they're clocking some serious revenue growth. The numbers are in the thousands, so it's not even worth quoting. And the PE ratio is around 30. So then you have a question of, okay, on the face of it, Uber doesn't pay a dividend. They did start a buyback. So if you're just going to look at that metric, you're going to say Uber is not very it's not a good value versus Verizon. But if you look at any other metric, including growth, including expected future cash flows, it's a much better value than Verizon, at least in my opinion. I would expect a company growing at close to a PEG ratio of 1, let's call it, or some metrics, PEG ratio well below 1, would have an expected return much greater than the dividend yield of Verizon. And that's what we're hoping for, and ultimately I think that stocks do reach their value. I think the price comes to close to what you get in the long term, not necessarily in the short term, but in the long term I think that's true. So that's a good example of how I think Uber is a better value, even though it's a quote unquote growth stock, than maybe the conventional company like Verizon, which is probably bucketed as a value stock.
Thanks. I want to take a moment to just mention for compliance, mention of specific stocks is not a recommendation or offer. Individual investors should do their own due diligence to determine opportunities for their own circumstances, and always consult your advisor. Or if you need help with that, you can certainly reach out to us. So this was a good conversation. Thank you, guys. I appreciate it. And anything to add? Anybody want to add any additional thoughts before we wind down? No.
Thank you, Brian. Great comments.
I just wanted to tag on at the end. I did a brief synopsis on Uber and Verizon there, but one of the things I think is important the longevity of these companies, right? We want consistency with that growth. We've established that Uber has significantly more growth, but do I think it's going to last longer than Verizon? And this is why Uber is trading so inexpensively. There is a big debate about what is going to happen when automated cars come in. I think it's a very fair and healthy debate. What my position is probably going to be is they're going to make a lot of continued agreements with companies that they've made with Waymo. With Waymo, they've basically said you can have access to our platform if we can have access to your cars. And they have a partnership. I think that's going to continue with most autonomous driving, which I think is an exciting opportunity. Why? Because they have the network effects. They have the people who are already on the app. Why try to recreate that community when it's already there, when you can just go in a partnership with Uber? So that's my position, right? So that's why you have to think about the business model in the long term. Now, Verizon, it might seem like, they have very few competitors, but they have two very big competitors in AT&T and T-Mobile, along with some smaller competitors. In addition to that, goodbye to linear TV. That's not even a business that they're in anymore. And hello to Starlink. I don't think that gets a lot of talk yet, but reasonably, this is providing internet access to places that don't have internet access. Satellite internet hasn't been reliable in the past, but I have reason to believe that that could change. I mean, just like everything, things tend to get better with time. So, we get those two big competitors, and they obviously have more competitors. They have some businesses that are dying. They have a lot of debt. These are all things to consider about the longevity of that business model. And I'm not saying that Verizon is going to go away anytime soon or anything like that. I'm just saying, if you're going to compare, the upstart versus the incumbent, which in this case we kind of are, I think it's a fair conversation or fair thought experiment to have.
Good stuff. Brian, it's been fun having you on. Thanks for joining us today.
Thanks for having me, guys. I really enjoy it.
Before we wrap up, I wanted to wish my mom a happy birthday. And for anyone else, if you need any help with your financial planning or portfolio management, don't hesitate to reach out to us. Until next time, everybody, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's for financial planning or portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at somethingmorewithchrisboyd.com or call us toll free at 866-771-8901. Or send us your questions to amr-info@wealthenhancement.com. You're listening to Something More with Chris Boyd Financial Talk Show. Wealth Enhancement Advisory Services and J. Christopher Boyd provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is general financial comments and cannot be relied upon as pertaining to your specific situation. Wealth Enhancement Group cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.